Hello, this is Chris McKeffey from BX Partners here today with Charles Helm, Managing Director and Portfolio Manager at BH Asset Management. We're here today to talk about Charles's U.S. large cap growth strategy. This growth strategy has a very impressive long-term track record over a very long period of time. So we wanted to get Charles on today to kind of take us through an overview of the strategy to give you a feel for it. Charles, can you describe just very broadly what the strategy is about?
Sure, Chris, and thanks very much for having me on today. The BH Asset Large Cap Growth Strategy is not an aggressive growth strategy. It's a sustainable growth strategy. So typically the companies are high quality, they're established companies, they're self-financing, and they're more GARP than go-go stocks. So you won't find a lot of IPOs in our portfolio. In fact, very few IPOs. You might find some spin-offs or some companies that are benefiting from corporate events such as separation of a lower profit business. But for the most part, all of our companies have very established managements. They are proven to have success in their businesses and business lines. And we manage concentrated positions with maybe 20 stocks in the portfolio. So we have very few eggs in our basket and we watch them very closely.
That's great. Thanks, Charles. So you have expertise in several different spaces. Why did you choose to run this particular large cap growth strategy?
Well, we think the best opportunity for success is investing in the companies of established, successful, fundamentally strong businesses that with excellent managements that are compounding at high growth rates. And those have proven to be the best creators of wealth over time, both for our clients and for investors everywhere.
Thanks, Charles. So you're aware that there are a very large number of strategies available to advisors in the large cap growth space. How is your specific strategy differentiated? I think you might have touched on this in the overview, but maybe if you could go into a little more detail on that.
Well, you can point to one specific metric and back test it against any other metric in the growth space, and you'll see that high ROE companies are successful and provide the best returns. So we focus on high ROEs. We do look for accelerating top line growth and accelerating earnings. But we're not an earnings surprise shop, and we're not a momentum-based or price momentum-based shop. Most of the companies that we invest in are not cyclical growth companies, but they have sustainable growth over a business cycle, and their business models have stood the test of time. So whether it's in an inflationary environment or a deflationary environment or a recession or a boom such as we're having now coming out of the recovery, our companies have done very well during all those economic environments and have created wealth for their for their investors over time.
Thanks, Charles. So there's been some interesting dynamics at work lately in the market where after a large run of growth outperforming almost constantly versus value, where value took back over and then kind of seesawed again a little bit, why would I want to commit assets to this strategy now?
Well, if you think about sustainable growth, you're not talking about the Zooms or the Virgin Galacticas, none of the moonshots. Those companies have done outstandingly well during a period when there was no growth because we were in a deep recession and people were working from home. And the only way to build top line was to sell things over the internet. And now in this recovery phase, where supply chains are stretched and materials costs are going up, it seems likely that those companies that have established businesses are going to do well. If they are dominant in their field, they're going to do extremely well because they're going to have the strength of their suppliers and vendors to treat them better than nascent companies that may struggle to obtain either financing or
So, once again, kind of why would this strategy be appropriate and timely for investors in the current market environment or right now?
Well, we're entering a very choppy environment where interest rates and inflation are rising, and the discount rates for growth to infinity are rising. And that means that the growth at any price companies are going to be disadvantaged, where the terminal values are extremely high and dependent on zero interest rates. Our companies are more growth at the right price, that is, they're growth at reasonable prices that are accelerating through this recovery rather than maybe disadvantaged because the work from home that helped those growth at any price companies is starting to reverse. As people go back to work and inflation increases and demand increases, supply issues become paramount. And those companies that have very strong vendor and customer relationships are going to benefit tremendously, whereas more nascent companies that have had high growth rates as they tried to scale now may suffer some indigestion as those new customer acquisition numbers decline and as people go back to work.
Yeah, that I think that makes a lot of sense, and a lot of advisors are going to agree with you that being able to buy growth at the right price in these established businesses might well be the best way to go in the current environment. Thank you very much, Charles. And everybody, for more information on the strategy or to set up a more in-depth conversation, please get in touch with us here at BX. We can get you a full presentation. We can arrange an additional conversation, etc. Thanks very much for your time.